Okay, hopefully everyone can see this presentation. Please let me know otherwise. I'm going to try to give everyone just an overview about how we at McKinsey have been thinking about the evolution of what we call the kind of the virus and the economy. And then how that kind of plays through to how to think about how markets are evolving wherever you happen to be, and then what to expect in the future. For the construction piece, I will focus largely on the U.S., where I've been spending quite a bit of time. I think where we always start here in the same place, and that is just emphasizing that since we first wrote our Saving Lives and Livelihoods piece back in March, there's always been two imperatives. The first, of course, is safeguarding our lives and making sure that we suppress the virus and do whatever we can to help those who have been afflicted by it. And the second piece of this is what we called at the time safeguarding our livelihoods, which back in March, there wasn't a big focus of concern, but we raised it because we knew we would get to the point where we are right now, which is how can we balance, getting ourselves through the virus, but also getting the economy on track to be able to ensure that those of us and our families and our colleagues and our neighbors can all be able to live through this economic shock and come out the other side in decent shape. So it's always important to start there and emphasize those twin imperatives. When we think about what's going on and how to frame the impact of the virus and the economy, we put together this framework at the time, and it's stood with us since then. And there's really two pieces to it. The first is around the virus spread and public health response, which you see on the vertical axis. And the way to think about that is just simply two questions. The first question is, can we stop the exponential spread of the virus? And the second question is whether or not we can open societies safely. If you go across the horizontal axis, which is about the economic response and what we call the knock-on effects, which is how these economic responses play through the economy, there's also two questions that one has to answer. And that is, can we stop the free fall that was initiated through the initial lockdowns? And then can we restart growth sustainably? And if you're able to answer yes to all four of those questions, you're likely someplace in developed Asia or particular pockets of Europe, and you would be in this kind of upper kind of quadrant here where you've been able to effectively control the virus and get confidence back up and get reopened in a safe manner, and you're on a growth trajectory which kind of picked up where you left off. If for like most of the developed world, you're answering yes to the first two questions, which is yes, we've been able to figure out how to stop the exponential spread of the virus, and yes, through the massive stimulus programs that we've each undertaken in our own countries, we were able to stop the free fall of the economy. But we're still struggling to reopen society safely and restart growth in a sustainable way. And that puts you in this kind of zone of this kind of A1, A2 type zone, which is where the United States, the UK, and most of Europe finds itself today. Just one quick comment on these little B scenarios around the outside. When we did this in March, we honestly did not know whether or not there was going to be an uncontrolled pandemic. And we did not know whether or not governments were going to respond effectively. So there was a huge amount of tail risk out there, which we kind of summarized in these B scenarios, and I think largely have been able to avoid in most parts of the world. There is some concern now of a second resurgence or third resurgence, depending on where you are, and a double-dip recession. But again, at the time, we didn't know. So the good news is we haven't had to go there by and large. So what do we actually know today? This is global GDP. It's indexed to 100 in 2019 Q4, and the Q2 number, which is the bottom of this little V here, is an actual number as of September 7th, as reported by Oxford Economics. The third quarter number is our best estimate right now of where the third quarter is going to end up when the numbers start getting printed in the next 2 or 3 weeks. It'll take till about December till we actually know totally for the world, but given that it's behind us, we have a pretty good sense of where we think that's going to come out. And that's going to come out essentially clawing back about half of the fall that we had in Q2. And as you can see, Q2 landed pretty much right in the middle of the scenarios we'd originally laid out in March. And then the Q3 number is kind of tracking this A3 scenario. And if you recall, the A3 scenario is in this upper quadrant here. So that's rapid virus control and a decently effective government response. So the question that we face today is indicated by these arrows and by this question mark, which is, are we really truly on this tracking scenario from a global GDP perspective where we're going to continue up, or are we still facing headwinds, right? And that's true across the world largely. If I take a look at the Eurozone, there's really two outcomes that are of most most likely to probably frame where we'll end up. And there's also some risk, as I said before, of this kind of double dip in the fourth quarter. Let's talk about just quickly what does it mean to be in this kind of upper, what we call the A2 prime scenario. And consistent with how I framed it at the beginning, there's essentially two things that have to happen. One, in the country of your choice in the Eurozone, the virus has to be under sufficient control by the end of this year so that people are out and about and acting nearly back to where we were before the virus hit us. And you also have to assume that there's a significant amount of additional stimulus that gets put into the system by the local governments or by the EU. You need both of those conditions really to make 2021 this really very strong kind of bounce back growth year. If on the other hand, we are not, we don't believe that growth is sustainable, and we are facing struggles in the virus and additional shutdowns, you're more likely to actually have another patch of relatively flat growth before hopefully we turn the corner sometime in the middle of 2021 or the end of 2021, when we do have the virus more under control and potentially start to achieve some herd immunity from a vaccine, et cetera. We could face a resurgence, which puts us down on this gray path here, and that would mean additional lockdowns. And so where you are depends on what you believe again in terms of the virus and the economy. And the same thing holds true quickly for the U.S. The shapes look very similar because the U.S. and Europe are in very, very, very similar places. Just to put some numbers on it, in the U.S., we're talking about another $1 trillion in spending that would have to be added by the government to actually get this thing moving. And as you know, we are struggling to some extent in getting the virus under control. It's really important to realize what's happened in Q3. And I'm just referring to this as the light switch effect, which is essentially we turned a whole bunch of stuff off, and then we turned a whole bunch of stuff back on. And by doing that, we've got this kind of bounce back in GDP. But the question is whether this underlying growth is actually sustainable, or whether there's just kind of a mechanical switchback. You see exactly the same picture in every country in Europe. The deeper the countries have gone down, let's say the UK and Italy, the bigger has been the bounce back in this Q3. My own view is that it's very unlikely that this bounce back in Q3 is a sustainable, shows sustainable demand, at least overall, and you're much more likely to face significant headwinds in the U.S. and probably a decent amount of Europe through the through the end of this year and into the beginning of next year. It's also, just to give you guys a data point, the Q3 number in most of Europe and in the U.S. will essentially bring us back to the worst performing quarter that we had during the Great Recession in 2008, 2009, right? So we're still, it's great to have that growth back, or that income back, if you will, but we just need to keep it into perspective here, that we're still got a long way to go. Let me just say something quickly about stimulus in the U.S. to try to bring this to light, and then I'll hit the construction piece. On the left-hand side, you have the number of people that are actually continuing to receive some type of support at some level of government. That's about 25 million people. The peak during the global financial crisis was 11.5. And you can see on the right that this is billions of dollars on a monthly basis that was paid out to households and small businesses, if you will. And that's a huge amount of money. This is about almost $800 billion. But most of the additional stimulus has now dropped off, and there's kind of the usual programs are sustaining things. This is what Chairman Powell of the Federal Reserve and others are worried about in terms of the lack of additional income that's in the economy. And this cliff that you're seeing here is what was what is driving most economists and most investment banks in the U.S. to suggest that the fourth quarter is actually going to be pretty tough. In fact, maybe flat. How does this translate? Well, there's a number of ways in which all of this translates into construction. In the beginning, across these various asset classes, there was obviously the short-term supply disruption, and construction projects were halted, and that was kind of a negative kind of headwind on just about everything. And this has kind of got a U.S. view in mind. It's similar in most European countries. Clearly, it also slowed project development, right? Because we couldn't move as fast. And there's also, uncertainty from owners and regulators, capacity constraints, and all those kinds of things. In terms of a fundamental demand shock, there's no question that the non-residential market is taking a big hit, as we'll see, and starts are down in a way which suggests there's going to be a big air pocket sometime soon. But at least in the U.S., the infrastructure and the residential have amazingly kind of powered through. And the question then becomes what are the mix shifts and what's happening, and what are going to be the impacts in the next normal when we get through this. We believe that from a residential perspective, there's still going to be additional tailwinds for a number of reasons in the U.S., and that if we do get some government stimulus, that will help as well. Right, so that's kind of translating from macro down into construction. Let's look at some specific numbers to try to bring it to light a little bit better. This is residential construction activity, current activity on the left, and starts, future activity on the right. And as you can see, there's been a bit of a wobble in terms of current activity, but by no means anything close to what we were seeing on the previous charts in terms of GDP or what we've experienced across many, many industries. So residential housing in the U.S. has been able to power through just because it was, coming into this, all of the positive factors that were giving it momentum, from increased household formation, which has finally made it back to pre-Great Recession levels. There's very low debt, very low interest rates. There's a lack of supply. All of those things kind of conspired to enable the residential piece to continue to move through. And as you can see, even though starts initially kind of took a very significant jump down, they bounced right back. Right. What that means from a scenario perspective is that we are back now. It's taken 10 years to climb out of the hole from the Great Recession, but we're going to look like we're going to be back in between this kind of band of about 1.3 million starts at an annual rate in the U.S. Barring a real wipeout in policy. Which is this B2, which I haven't even discussed yet, and seems unlikely. So it's going to continue at a high level, if you will, and that's going to continue to make all the markets tight and supply tight, procurement, and all of those factors. When you have tight markets, are going to continue with us in the U.S. for the foreseeable future. If you look at the non-residential side, what we see, this is now broken up into non-residential structures, which is kind of like the lodging and commercial and educational religious establishments, and then this kind of infrastructures and buildings, which is the public safety, transportation, communications, etc. And what you can see again is that the non-resi construction activity has kind of hung in there. And also the future activity for infrastructure is there, but we're still down quite a bit on non-residential structure starts. And the reason for that is quite clear. As we all know, it's very expensive to start projects. And so we do see the activity continuing, but there's a ton of uncertainty about new projects. And so there is this question of when this air pocket is going to get hit, when the backlog is actually going to kind of play its way through. We kind of feel like, where we are right now, we're going to be somewhere. And again, this is a spending piece versus a starts piece. We think that it's going to take some time, for the non-residential structures market to actually be able to come back. And this is the way it always works with non-resident, right? Because it's late in the recession to go down, and it takes a while for it to come back. And this is being exacerbated by all of the COVID effects that we're all familiar with in terms of office space and everything else. So finally, then, where are we leading towards? Well, we're hopefully leading towards a COVID exit. And what does that mean from an investment and planning perspective? Because of the bounce back that we've had in Q3, we're encouraging our clients to make sure that there is some upside scenario within the context of your planning. And we're also looking at, kind of 2022. 2021 is going to be very messy. It's either going to be messy and we're going to make money in the sense that we're going to get growth back, or it's just going to be messy and things are going to be flat. But it is the year that investment and transformation has to get back on track if you hope to outperform over the next decade based on research we've done elsewhere. And what does that really mean? It means launching initiatives today to put you back on track and pulling all the levers that you can to make sure that you're ready, so that when the bounce back does come, we are indeed prepared as individuals and as companies to respond. So those are the quick comments from my side. I hope that was helpful. I'm happy to take any questions right now or go for the panel. Richard, just please guide me.
I think we'll go for the panel, Ezra. Thank you for that.